Lesson 1. What is the Forex? Before we get started, I would like to point out a couple items. Number 1, each slide is numbered. So if you look at the bottom of your screen in the center, you will see the number 2. That is because we are on slide number 2. And as you look in your workbook, at the bottom of each slide, there is a number in the center. As we go through this presentation, you can keep up with this presentation going slide by slide. The second thing is that all through all 16 lessons, I've taken the time to put this sign up in the top left-hand corner, important information. Whenever you see that sign on any of the 16 lessons, that sign is an indication that there is some critical and important information on that slide, and that you as a trader should take the time to really understand the information on that slide, even memorize it, because they are trading tips and techniques that can really improve your trading. There are 16 lessons in this whole presentation on trading the Forex. However, there are virtually 16 lessons on trading and on technical analysis. Now, technical analysis is the study of charts and their movement. So basically, if you get an education on technical analysis, you're basically educating yourself on any type of chart movement and how to trade it. The greatest thing about learning technical analysis and chart reading is that it's applicable in all markets. Several years ago, I heard this statement, and it's probably one of the most profound statements I have ever heard. Successful traders will do what unsuccessful traders can't and won't do. What's the difference between you and a successful trader? Obviously, education, experience, understanding of the market, understanding of their own emotions. Successful traders have a clear trading methodology and understanding of the market, and that makes them different, and that allows them to do successful things in the market that unsuccessful traders can't and won't do. These lessons can participate greatly in helping you become a successful trader. Now, there is a 21-day 3% rule that I learned about several years ago. It basically states that the human mind forgets 80% of the knowledge it acquires within 3 days. That means as you watch this lesson and all the other lessons about trading, if you don't use it, you will lose it. And you will lose 80% of the information within 3 days. Over the next 18 days, it will continue the loss of information until it settles at retaining only 3% of the original acquired information. That means that after 21 days, you will only have retained 3% of the information that you will be shown during these presentations. So please go back and review these tapes and CDs and understand what there is to know on trading so that you can become successful. Invest in yourself. Now, by the end of this lesson, you will understand more about the Forex. You will understand how to trade the Forex. You will understand that the Forex is a market for speculator trading. You will also understand that the Forex moves just like any other market, up, down, or sideways. And you will learn the different types of orders used in trading on the Forex. You will also learn how to place a trade on the Forex. Market Traders Institute Incorporated and ForexTips.com Incorporated teaches people how to trade. Let's get started. What's the difference between the Forex and the stock market? Well, we all know the stock market is virtually purchasing a stock or part ownership into a company. The Forex is virtually buying and selling money. The currency of a country is virtually a stock certificate of that country. The Forex stands for foreign exchange. Traders call it the spot market or the cash market. It is comprised of approximately 4,500 world banks trading their country's currency for another country's currency. It is traded in cyberspace. It is not the futures market. It is not traded in a pit. It is the largest market in the world. Reports are that $1.5 trillion a day is traded on the Forex. It literally dwarfs the U.S. Treasury bond market or the U.S. stock market. U.S. bond market trades about $300 billion a day. U.S. stock market about $100 billion a day. The volume on the Forex is more than all other world markets combined. It's traded 24 hours a day. As a matter of fact, there are 3 trading sessions every 24 hours. The Forex opens up approximately 7 o'clock p.m. Eastern Standard Time on Sunday evening and closes Friday at 4 p.m. Eastern Standard Time, and literally goes uninterrupted 24 hours a day from that Sunday's opening till that Friday's close. In a 24-hour period, there are 3 trading sessions. The first session that begins around 7 p.m. Eastern Standard Time and goes until 6 a.m. Eastern Standard Time is Asia. These are all the markets over in Japan, Hong Kong, China, Taiwan, Taipei, Korea, all the way down into New Zealand and Australia. Those markets are considered the Asian market. They overlap the European market. Europe opens up at 2 a.m. You can see that at 2 o'clock in the morning, between 2 and 6 a.m., Asia and Europe are open. And Europe goes until 11 a.m. Eastern Standard Time. Then the U.S. market opens up at 8 o'clock in the morning until 5 p.m. Eastern Standard Time. These are all the markets starting in Canada, going all the way down the United States, Central America, all the way down into South America. You can see that Asia and Europe overlap for approximately 4 hours, and you can see that the United States and Europe overlap for approximately 3 hours. And then the cycle begins all over again at 7 o'clock and repeats itself 24 hours a day. Now, why is the Forex new? Well, the Forex is not new. The Forex has been around for quite some time. However, it is new to the small investor. Back in approximately 1995, 96, the Forex opened to the small investor, allowing them to get involved in trading on the Forex. Margin requirements changed. Prior to 1995, if you wanted to trade on the Forex, you had to have a financial portfolio of approximately $1 million or more to trade on the Forex. Now the small investor can get involved. The small investor is an individual described as one who has approximately $2,500 of speculator capital to invest in the market. Now the Forex has $1.5 trillion in daily volume. What does that mean? Well, that means there are unlimited buyers and unlimited sellers on the Forex. That also means that it is very liquid, easy to get in and easy to get out. As a matter of fact, fills or your orders are filled within 3 to 7 seconds, 24 hours a day. It also means that you're not subject to some of like these stock buys, to where you purchase a stock, you find out the stock is not a very good stock, you got in on a hot tip and you're getting ready to get burned and you want to get out of it, but the stock is now not very liquid, and you tell the broker to sell it. If this stock gets down to $17, sell it. And the broker calls you back and tells you that he couldn't find a buyer until it hit about $8. And some of you have experienced that. The Forex is very liquid. You don't have that type of problem on the Forex. There's 6 major investment choices that we urge all our traders to focus in on, and those are the main world currencies, the 6 main world currencies. The stock market has over 40,000 different stocks to choose from. If you are a focused individual, or you're an individual that believes in focus and in niche, then how do you begin in the stock market with over 40,000 different stocks to choose from? On the Forex, there are 6 main currencies that we focus in on: the US dollar, the British pound, the Japanese yen, the Swiss franc, the euro, Canadian dollar, perhaps the Australian dollar. Those are 6 very liquid currencies that are very easy to trade. We have 4 trading strategies that we focus in on. The market only goes up, down, and sideways. As the market is going up, we teach a strategy on what to do, how to enter the market, and how to financially protect yourself. As the market comes down, we teach you how to make money as it comes down. We show you how to get in the market, how to enter, how to make a profit, and how to protect yourself. When it's going sideways, we show you how to get in, how to make a profit, and how to protect yourself. And the 4th strategy is we show you how to identify the reversal. What goes up must come down. What goes down, predominantly in the market, does come back up. We teach you how to spot that reversal so that you can take advantage of these big moves and get in at the beginning of a move. The neatest part about the Forex is it's traded 24 hours a day. You're able to trade it at your convenience, call your own shots. If you're a doctor, lawyer, engineer, architect, entrepreneur, employee, doesn't matter what walk of life you come from, if you want to call the shots, make your own decisions on the Forex, you get to do it 24 hours a day. And that is why people are slowly moving to the Forex. Now, there's 2 types of traders on the Forex. One is a consumer trader. Consumer trader is a trader who acquires ownership. If you purchase any sort of stock that you wanted to acquire ownership on, you believed in the leadership of that company, you believed in the product that they had to sell, you wanted to participate in its growth, you purchased that stock to acquire ownership. That is considered a consumer trader. If you have a savings account, let's just say you're Japanese and you have a yen savings account. Let's just say you're Australian, you have an Australian dollar savings account. Let's just say you're an American and you have a US dollar savings account, or a Canadian, you have a Canadian savings account, and you save money in that account. You are a consumer trader. You are saving money and trying to acquire ownership. Speculator traders are very different. They are not trying to acquire ownership. They are basically trying to anticipate price movement. They are trying to profit off of that price movement. They are virtually scalping profit as the market moves. Investors can be individuals, they can be banks, they can be businesses. Either way, speculator traders are anticipating price movement and scalping the market for profit. Now, there are 2 types of positions you will take in the market. One is what's called a day position, the new buzzword of the decade, day traders. Day traders in the stock market get in as soon as the stock market opens in the morning and gets out in the afternoon. That is considered a day trader. A day trader in the currency market, however, is a little different. Their day starts at approximately 3 p.m. for most brokers and goes until 3 p.m. the next day, which means if you enter into a trade at 6 o'clock in the evening and get out at midnight, you are considered a day trader. If you get in at 10 o'clock in the morning and get out at noon, you are considered a day trader. However, if you get in at 10 o'clock in the morning and get out at 5 o'clock at night, you are now what's called an overnight trader. An overnight trader is an individual that gets in today and out tomorrow. Perhaps 2 days later, 2 weeks later, 2 months, 2 years later. Warren Buffett purchased stock 40 years ago. He is a position or overnight trader. He is still in the market today, anticipating price fluctuation and every now and then selling off some of his shares to profit. Traders have been attracted to the currency market most recently, especially small speculator traders, because they are very trending. They have a tendency to trend down for what's called several 100 or 1,000 pips at a time, and then trend back up for several pips at a time. In the stock market, they call those points. We're going to discuss what a pip is here shortly, but in the currency market, you can acquire software that can participate in giving off buy and sell signals. You can see here, this is a buy signal. Based on this line crossing this red line, this is a buy signal. And one of these lessons focuses in on buy and sell signals and how to participate in that. You can see after this signal went off, the market rallied 1,000 pips, or if we were talking about points, it would be considered close to 100 points, and or perhaps 1,000 points. We're going to discuss that here. But be that as it may, speculator traders are turning to the Forex because it does offer a tremendous amount of trading ability. It allows you to make money as the market goes down, which is called short selling, and it allows you to make money when it goes back up. However, the reality of trading is this: 90% of all speculator or novice traders that try to trade in the market without some sort of help, mentorship, or education fail. Only 10% succeed. Why do you think the 10% succeed? Well, think about it. Successful traders will do what unsuccessful traders won't do. The 10% that succeed usually go out and educate themselves on how the market works before they get involved. And that knowledge gives them an edge. And with that edge, they're able to jump into the market and start profit taking from those traders that failed to educate themselves, and therefore the 90% pay the 10%. Now, trading on the Forex is called a zero-sum game. That means losers pay winners. The amount lost equals the amount gained. It's a lot like trading, or it's a lot like playing poker. See, when you play poker, the amount lost equals the amount gained. Losers pay winners on the Forex, which means if the odds are 90% lose and 10% win, for every 9 who lose, they pay the 10% that win. Therefore, if you can become part of that 10%, the returns are enormous. What's the objective of trading? Like all other companies, like all other businesses, to make a profit. And how do we make a profit? We buy low and sell high. It's no different in the trading arena. Now, how do we start trading currencies or stocks? Well, if you wanted to trade stocks, you would open up a stock account and acquire a relationship with a stock broker. On the Forex, if you want to trade on the Forex, you will find a Forex broker and you will establish a relationship for a margin account to trade with a Forex broker. If you do not know a Forex broker, we can help you find a Forex broker. You will need to open up a margin account. Now, a margin account, for those of you that don't know, is the following. If you open up a stock account, of which you acquire no margin, that means if you put in $1,000 into that trading stock account, you now have access to $1,000. If you want leverage, that means you give the broker $1,000 and he extends you what's called leverage. He will give you 2-to-1, 3-to-1, 4-to-1 leverage. 2-to-1 leverage means that if you give the broker $1,000 with credit approval, he will then give you another $1,000. You now have access to $2,000 in buying power. Or 4-to-1 would mean you would have access to $4,000 in buying power. In the currency market, there's what's called 100 to 1 leverage. For every $1,000 you put in the market, you will be controlling 100,000 in currency, and there is no credit needed. We're going to discuss how this works. And you can day trade this, or you can overnight trade on the Forex. Now, what's traded on the Forex? We trade what's called currency lots. In the stock market, you trade stock certificates. We trade currency lots. One lot equals approximately $100,000 traded in another country's currency.